As we speak right now, we are sitting on the brink of a disastrous housing market crash with interest rates increasing month by month, people's incomes going down, not up, and realtors all over the country reporting a slowdown in the industry. Yet, as this paradigm shift emerges, the US government has just announced and approved sweeping changes to the requirements behind getting a mortgage in the US, which will have huge consequences far beyond the naked eye. Today, we're going to explain exactly what is going on, what this will mean for the housing market, and why the US government is trying to make it easier for people to get a mortgage at this time. Now, right off the bat, we have to very quickly establish what a credit score is and why it's so important. Now, at a very simple level, a credit score is an artificial measure of how credit worthy someone is, and it takes into account a load of different individual things. It looks at how much debt you have right now, how much you've had in the past. It looks at how reliable and consistent you've been with paying off your debts, and whether or not you've ever defaulted on anything in the past. It also looks at how well you use your debt and if you use it in a responsible manner, and it looks at a bunch of other things as well, but really it measures how reliable you likely are going to be to repay a loan if a bank should give you one. Now, this is an incredibly important thing for obvious reasons because our lives are so often dominated by debt. We have debt for our cars and debt for our phones, debt for our education and debt for our homes, sometimes debt even for our holidays. And these credit scores not only determine which debt we're actually able to take out, but also how much it's going to cost us once we get it. Now, up until very recently, in the United States, your credit score was determined by 3 reporting bureaus, which established consumer credit scores for everyone in the United States. They were Equifax, Experian, and TransUnion, and they essentially controlled the entire market for credit scores as they go around and compile and sell credit reports to everyone in the country. Now, if you have a credit card or have had any kind of debt or loan in the past, then these 3 organizations know all about it, and they would then compile all the data they have about you and sell it to a bank if you were trying to get a loan from that bank. That, however, has just fundamentally changed because the Federal Housing Finance Agency just announced the validation of 2 new credit score models called the FICO 10T and the Vantage Score 4.0. Now, I know that that was just a whole bunch of words, but what that means is that the US government is making Fannie Mae and Freddie Mac use these 2 systems for measuring your credit score when it comes to giving out loans. Prior to this, Fannie Mae and Freddie Mac would have used the classic FICO credit rating system for almost 2 decades, and this is a major change that will have far-reaching consequences for the entire housing market. You don't need me to tell you just how insane 2022 has been for our investments. We've seen weeks where the S&P 500 has lost almost 20% and then rallied back 10% over a matter of days, but the trend is decidedly downwards with the S&P 500 putting up the worst numbers we've seen since the global financial crisis. It's no wonder then why so many people are looking to alternative assets to escape this volatility, with Goldman Sachs saying that the ideal allocation for stocks has shrunk from 60% to around 45%. But what do they recommend that you do with that difference in order to salvage your portfolio? Well, they say you should invest in real assets like art, and that's where Masterworks come in. They help you to invest in fine art that used to be reserved for the ultra wealthy. So far, they've bought and sold 7 pieces of art for an average net return of 28% to their investors, and that's during COVID and the subsequent bear market of 2022. As a result of this brilliant performance, Masterworks has had to acquire and release more art on their platform to meet demand, and there is now a waitlist to join, but you can skip it by clicking the link in the description of this video. I've been working with them for about a year now, and nothing makes me happier than seeing my subscribers make good returns with Masterworks, so go ahead and join the thousands of other Stoic Finance subscribers who've already joined Masterworks and click the link down below in the description. Now back to the video, and we've discussed what the changes are, but again, it was really just a whole bunch of words, so what does it actually mean? Well, these 2 brand new systems work slightly differently than the historic FICO system that existed before. Credit scores, as a result, will change as these new things go into play, and what we should see is the number of people able to get mortgages increase. This is basically the United States government changing the regulations and changing the rules to allow more people to get mortgages and buy up homes. On the surface, this should actually increase buying pressure for homes in the United States, at least in the mid to lower ranges of homes. If we think of it as the number of people considering to buy each single house on the market, with the previous rules, there may have been 5 people looking to buy this singular property, but now with these mortgage changes, now maybe there's another family able to get the necessary mortgage, so there's 6 people. That leads to some increased demand, and on the macro scale across the entire country, when you're looking at thousands and tens of thousands of homes being sold, this could serve as a force to move home prices upwards. It's also worth noting that some people actually might see their credit scores decrease from these changes. For how many people this is going to impact in that way, we really just have to wait and see, but new components have been added to what determines a credit score, like how much cash you have in your bank account right now and in the past. If you have never kept much cash on hand before, well, in the past that wouldn't have impacted your credit score at all, but now going forward it actually will. Now, a really important question that a lot of people are probably asking at this point is, why is this change actually happening? Well, here it's time to put on our conspiracist hats for just a moment, because obviously the housing market is in a very tough spot right now. In what is a surprise to absolutely no one, demand for homes is drying up, and those massive bidding wars that we saw last year are a thing of the past as the market has fundamentally changed. Interest rate hikes by the Federal Reserve are designed to slow the economy down and inflation too, and it is slowly working, but with that comes a recession. Mass layoffs are happening all over the place, with thousands of staff being laid off every single week in some of the biggest, highest profile names in the world like Facebook. Americans are being declined for credit and mortgages at rates that we haven't seen in a long time, with 33% of all Americans over the last year alone having some request for credit declined. This act is to try and make credit easier to get, and it seems to be an attempt to limit the damage of the tightening cycle and the recession that we're currently seeing. But unfortunately, this is very counterproductive to the actual rate hikes we're seeing in the first place, so it really doesn't make much sense. The Fed wants to do multiple things at the same time, and they just have to accept that that is not possible. To kill the inflation that is rampant all over the world, the economy needs to be massively slowed down and actually put into a recession. That will mean that house prices fall, and the Fed just needs to realize that that is the lesser of two evils here, and they can't maintain high house prices if they want to kill inflation. Now, as for what the average person should actually be doing in response to these changes, well, there are two things that really jump out at me. And the first is that we should just be trying to ensure our credit score is good in the first place so that we have the best possible outlook when we actually need to go and acquire some debt. Now, if this is something that you really need help with, then this just isn't the video for you, but there are literally thousands of videos and articles all over the internet explaining everything that you can do to ensure that your credit score is as high as possible. But in short, make your payments on time when they are due, pay your bills in full whenever possible, and don't run around opening or trying to open many new forms of credit all at once. The second thing we really need to think about here, though, is the housing market, because this change could impact the housing market in a very direct way by increasing the availability of credit and making it easier than ever to get a mortgage. Now, on the surface, this could help home prices to rise a little bit higher than they otherwise were, as it could increase the pool of potential buyers and increase buying pressure and force home prices up in that way. In reality, though, I think the downwards pressure that we're currently seeing on housing prices right now is far too strong, and so I really do doubt this is going to have an outright impact on housing prices rising, but it could stop the market from falling too dramatically, even if it doesn't outright raise prices. Now, this might sound like a good thing, and I'd understand why you might think that, as housing market crashes can be disastrous and are rarely a good thing at all, and if this helps to prevent the coming crash from being too bad, well, that can't be a negative, right? Well, unfortunately, that's only true in the short term, because all this change really does is make it easier to get a loan. It doesn't actually make it much easier to pay that loan off. If we do see the pool of potential buyers increase and people who previously couldn't afford to get a house suddenly can, well, that's likely going to bite those buyers in the arse in the long run when the housing market crash is finally in full swing. Those who could only just afford to actually buy these homes with these changes are going to be far more likely to miss their repayments and lose their homes than those who could actually manage fine before these changes came into effect. As a result of this, in the longer term, we may even see the housing market crash get worse, as an influx of buyers will no doubt be concentrated around those who are less financially secure. We could see this increase the number of defaults and foreclosures, which would of course negatively impact housing prices, just as we saw happen in the 2000s, and I don't think that's a good thing at all. We need to be aware of this and conscious of this possibility, especially if we are one of those who can suddenly get a loan with these new rules being implemented. As always, the answer to house prices dropping is just really to grin and bear and to try and withstand the crash. Live within your means, work hard, and the chances are that you will emerge the other end of this ordeal better off than you were beforehand. Make sure to go and check out the links down below in the description for Masterworks. And until next time, stay stoic.